Love accounts, accounts will love you back. Remember that, okay? Okay, we're still in a manufacturing account. This is the part 3, video number 3, lesson number 4. Okay, lesson number 1, we learn about introduction for manufacturing business. Lesson number 2 or part 2, lesson number 2 or part 2, we learn about how to do manufacturing account with work in progress and without work in progress. We learned that. Okay, lesson number 3, I didn't do any video. Lesson number 3, I give you some exercise to do. Okay, I believe you people have done, and then you have done one test also. If you haven't do the test, please go to the WhatsApp group and check the link and do the test first before we do the lesson number 4 or video number 3. Okay, at the end of this lesson, students must able to construct trading section of the income statement of manufacturing business and also income statement, the full income statement. Number 2, construct the statement of financial position of the manufacturing business. And number 3, implement year-end adjustments into a manufacturing account. Okay, year-end adjustments means the accrued, prepaid, depreciation, provision for doubtful debt. All these are year-end adjustments. Okay, we will learn these 3 things in this lesson. Preparation of the threading section of the income statement of manufacturing business. Okay, you people know what is the threading section, right? Okay, from the we start from revenue until the gross profit. Okay, we'll see how the threading section of the income statement for the business, manufacturing business. In the income statement of the manufacturing business, purchases, okay, purchases will be replaced with the production cost of goods completed, which is the cost of production lah. Okay, the purchases will be replaced with the cost of production. We see one example. Okay, this is the normal income statement that we normally prepare. Okay, revenue until the gross profit. Okay, inside here, can you see the under the cost of sales, we have our opening inventory as usual. Then we have a purchases. Okay, these purchases will be replaced. Okay, for the manufacturing business, these purchases will be replaced with cost of production. Okay, this is how we present the income statement of the trading section for manufacturing business. We continued it, but sometime, however, a manufacturer business may purchase some finished good. Okay, yes, most of the time manufacturing business will produce and sell the product, but sometime they have no choice, they need to buy the finished good and sell the finished good. Okay, why? Okay, why? This may occur. We see the 3 reasons why there is such situation occur. First one is when a production does not meet a demand, or we produce at the maximum level. Example, the demand for the particular product in our country maybe 100,000. We need to produce 100,000 unit and sell, but unfortunately our maximum production level is only 90,000. We can produce 90,000, but we need to meet a demand of 100,000. So what we do, we will produce the 90,000 and another 10,000 we buy from another manufacturer, maybe another country also can lah. Okay, another manufacturer, we buy from another manufacturer and then we sell to our customers, so to meet the demand. Okay, this is the reason why we have purchases of finished goods. Okay, another reason is when it is cheaper to buy the goods rather than make them. Okay, let's say we are producing 20 items. Okay, we're producing 20 products. Out of the 20 products, suddenly we realize there's a 2 product. It is cheaper to buy from another supplier or another manufacturer. So what we do, we will produce 18 product and then sell to the customer. Another 2 product we will buy from outsider or buy from another manufacturer and sell to our customers. So here we have a manufacturing cost for the 18,000 unit, and we do have purchases finished good. Okay, purchases of finished good for the 2 product. Okay, the last reason, okay, the stated here is when those particular item cannot be made by the business. Okay, sometimes we have some barriers, example government rules or something like, okay, or we don't have the technology to produce the particular one product. Okay, so what we do, we will buy from outsider or another supplier and then we sell to our customers. These are the 3 reasons why a manufacturing business have purchases of finished good. Okay, we see one example. Now before the one example, can you see the last line? This one. Purchases of the finished goods are added into the production cost of the goods completed in the income statement. Okay, how to add, how to show the format, we will see one example. Okay, this is one example of the manufacturing company's income statement. As usual, they start with revenue and everything. Can you see the cost of sales? Under the cost of sales, we have opening inventory, finished good. Under the opening inventory finished good, we have cost of production. We have a cost of production. That particular cost of production need to plus with purchases of finished good. So since this question we have a carriage inward, so we plus also with the carriage inward, and the total purchases of finished good and carriage inward will be added on with the cost of production. Then others all as usual. Okay, this is how we present the income statement for a manufacturing account with cost of production and also purchases. Okay, basically we have learned 2 type of a trading section. First one is without the finished good, without the purchases of finished good. Okay, thus the purchases will replace with cost of production. The second one is this one, cost of production plus with the purchases of finished good, and others all we do as normal. Okay. Video example number 4. The following information was provided by the current manufacturing company on 30th April 2016. Cost of production, this from the manufacturing account this much. Revenue is this much. Finished goods is this much. Finished goods inventory, opening inventory, closing inventory, and can you see or not? We have a finished goods purchases. Okay, this is the second formula. Prepare the trading section of the income statement of the current manufacturing company for the year ended 30th April 2016. Okay, this is very easy. The normal income statements trading section. Okay, we start with revenue. How much is my revenue? 661,500. After that, minus with cost of sales. This is the header. Just leave it like that. Under the cost of sales, we'll start with what? Yes, opening inventory of finished good. You must write like this, opening inventory of finished good. Okay, how much is the opening inventory of finished good? 31,000. After that, we have cost of production. How much the cost of production? And normally this cost of production we get from manufacturing account, but for this one they already give you 475,000. This cost of production need to plus with yes, we have a purchases of finished good. Okay, plus with purchases of finished good. Okay, opening inventory, cost of production, purchases of finished goods. You can just plus these 3 together. Okay, or what you can do, you just go to the create another one line. Okay, write the cost of production and purchases of finished goods. You plus together and then plus with opening inventory also can. Both format acceptable in IGCSE. Okay, this one need to minus with closing inventory of finished good. My closing inventory finished good is 23,250. I minus, I get a cost of sales. Okay, revenue minus with the cost of sales, we'll get the answer. That answer we call gross profit. As simple as this. Okay, now we see preparation of the profit and loss section of the income statement of a manufacturing business. Nothing much. It is exactly same as a trading business. Okay, you remember gross profit plus plus other income minus other expenses. You'll get profit for the year. But remember, there are some expenses will be apportionate. Apportionate means they will divide among the office and factory. Remember, the one that for factory will go to the manufacturing account. The expenses for the office will go to the income statement. Remember that. Okay. Then next one is year-end adjustments. Year-end adjustments also same as trading business. Okay. Year-end adjustments means the accrued, prepaid, depreciation, and everything lah. Okay. Okay. Before we continue, we do a very quick revision on the year-end adjustment. Year-end adjustment actually got three. First one is adjustment on the income and expenses. Okay, normally for income and expenses we have only two things lah: accrued and prepaid. What you need to know is which one to plus, which one to minus. Okay, I believe you people know already. Okay, we just try to recall it lah. Okay, accrued balance CD. Okay, accrued balance CD. Before that, you know what's accrued, right? Accrued, the thing that we haven't pay, we owe the people. Okay, accrued balance CD will be plus into our current year expenses or current year income. And next one is prepaid. Prepaid is you overpaid. You overpaid means we already over recorded, so we need to minus end of the year. But whenever the same thing, it's come to balance BD, which is the opening. Balance BD means opening. Accrued we will minus, prepaid we will plus. Remember this, very important whenever you want to do the year end adjustments. Okay, accrued balance CD plus, prepaid balance CD minus. You remember that. Okay, the balance BD will be the other way around. Okay. Okay, next one is non-current asset, mainly depreciation. Okay, depreciation got three format. Okay, three methods. You need to know the formula to calculate the three methods. First one is straight line method. Okay, straight line method actually got two formulas. Okay, the first formula is cost of the assets divide with the number of the years use. Okay, how many years we can use. Okay, cost of the asset divide by the how many years you can use. The answer that you get is your depreciation. Okay, but sometimes the question don't give us the number of the years used, so the question will give you cost and then the percentage. If the question give you cost and then the percentage, we will use the another formula, which is cost times with the percentage. Okay, the famous one is this: cost times with the percentage. Most of the questions they will ask you to do this: cost times with the percentage. Second method is reducing balance. Okay, anybody know what is the formula for reducing balance? Cost minus with the accumulated depreciation times with the percentage. What is accumulated depreciation? The previous year's depreciation lah. You take the cost minus with the previous year's depreciation and then times with the percentage, then you will get the depreciation under the reducing balance method. Okay, the third one is revaluation method. Okay, revaluation method also very easy. You take the opening cost of non-current asset plus with purchases of non-current asset minus with closing cost of non-current asset. Okay, then the value that you get is your depreciation. If you get 0, there is no depreciation for this question. If you got some value, the particular value is your depreciation. We learned this under club and society, you remember? Okay, the third year and adjustments is provision for doubtful debt. What's the formula to calculate provision for doubtful debt? You take a trade receivable times with the percentage. Take a trade receivable times with the percentage, you'll get the provision for doubtful debt. I normally will call that PDD. Okay, and remember, if the PDD increase, that one is your expenses. If your PDD decrease, that's your income. Okay, what's increase, what decrease? Compare with last year's PDD. Okay, last year's PDD normally will be in a trial balance in the question there. Okay, we compare with the last year's one. Last year is 200, this year is 210. So the 10 is your expenses for this year. Or another example, last year's 200, this year 180. So it's reduced by 20. That particular 20 will become your income under the income statement lah. Okay, these are the three main year end adjustments that we need to know before we do the full question. Okay, now we do the statement of financial position. We are not going to do the full financial position. We're going to do only the part which the different compared to the normal business lah. Okay, before we continue, you need to know this. We have three different type inventories. Okay, we have three different type inventory. What are the three different type of inventory? Do you know? Yes, raw material, work in progress, and finished good. Manufacturing business will have a three type of inventories. Okay, but normal companies, normal trading companies will have only one inventory, closing inventory. Okay, that closing inventory is finished good. But for manufacturing company, we'll have a three type of closing inventory, which is raw material, work in progress, and finished good. Okay, we do example number 5. On 30th April 2016, the current manufacturing company had the inventories valued as follows. Okay, we have a raw material this much, work in progress this much, and finished good this much. Prepare a relevant extract of statement of financial position. What is the meaning of extract? Only a part of statement of financial position. Okay, raw material, work in progress, finished goods are closing inventories. Do you know under the statement of financial position, closing inventory will be in which part? Either NCA, CA, or C, NCL, or CL. Yes, current asset. So we write current asset. Under the current asset, we write how much is our closing inventories. First inventory that we have, raw material 15,300, work in progress 8,640, and finished good 23,250. We total up and write the total, and then after that, as normal you plus the NCA plus with the other CAs and everything. Normal statement of financial position. Okay, only this current asset part will be slightly different than normal business, so I show you here. Okay, we will discuss this question, but you people need to do yourself. Okay, we read the question. Mustafa opened a garment factory 1st August 2016. So this is the brand new company. How I know? Because they say it just started lah. So for this question, we won't have opening inventory, opening work in progress, anything lah. No opening for this question because this is the brand new company. On that date, he purchased the following non-current asset. Okay, he got premises, factory, machinery, office fixtures, loose tool. Then they give you some additional informations. Then what the question asked me to do? The question asked me to prepare the manufacturing account. B, the question asked me to calculate cost of sales. They didn't ask you to do income statement. They just asked you to calculate the cost of sales. Okay, we'll do it. Okay, first one, we read this part. Wait, let me take a highlight. Okay, we read this part. Start here. Mustafa decided to revalue the loose tool at the end of each financial year. Okay, we stop there. This is the loose tool. Actually, they ask you to calculate the depreciation for loose tool. Revaluation is the one of that. Can you see the revalue there? The revaluation is actually one of the method in the depreciation. So how to revalue? We will see. Opening loose tool depreciation. Opening loose tool is 19,600. Do you have any other loose tool? Can you check the question? Yes, at 31st July 2017, I can see loose tools were valued at 18,100. So we have an opening balance, we have a closing balance. We don't have any purchases of loose tools. So how we calculate the loose tool depreciation? Opening balance 19,600 minus with closing 18,100. The difference will become my loose tool depreciation. I continue it. and also decided that no depreciation would be charged on the premises. Okay, so no need to do anything. Okay, no depreciation, so no need to do anything. The other non-current assets are to be depreciated using straight line method on the depreciation. Okay, the other non-current asset, what are the other non-current assets we have? We have factory machinery. We have a factory machinery and office fixtures. So we need to calculate the depreciation for the factory machinery. So how many percentage for factory machinery? 20%, and office fixtures is 15%. Okay, I take the factory machinery is 92,000 times with 20%. I'll get factory machinery depreciation 92,000 times 20%. But the next one, office fixtures. Wait, we are doing manufacturing account. In a manufacturing account, we only take the information related to the factories. Okay, or anything happen in the factory, anything happen in the office fixtures will go to the income statement. And this question, we are not going to do income statement, so I don't want to waste my time to calculate office fixtures depreciation. I don't want to calculate the office fixtures depreciation because that one will go to income statement, not to manufacturing account. Okay, we continue next one. Okay, can you see the general expenses are to be apportioned 3/4 to the factory, 1/4 to the office, and the rate and insurance to be apportioned 2/3 to the factory, 1/3 to the office. Okay, for the office I don't care because we are not going to do the income statement. If the question asks you to do the income statement, then we need to calculate the office as well. But now we are our focus only for the factory. So first we see the general expenses. General expenses is 13,400 into you need to times with 3/4. So that one will become your general expenses for the factory. And also rate and insurance also times with 2/3 because only that portion is for your factory. So we'll put in the factory. Okay, next one we see we will classify which one go where. Okay, which one will go where. First one is direct material. Okay, can you see the direct material is DM. Okay, next one is direct material returned. So DM also direct material DM, and finished good will go to the income statement. Income statement, and sales also will go to the income statement. Okay, wages of the factory operative. This one will become your direct wages. Direct wages is DW. We will label as a DW. Factory supervisor. Supervisor is factory overhead. Office staff. Office staff we cancel. Office staff we cancel because anything related to office we don't record. Cancel. It will be in an income statement. Next one is general expenses. General expenses, the 3/4 portion will go to factory overhead. The balance is income statement, but we don't care about the income statement. Rate on insurance also factory overhead, the 2/3. The balance 1/3 is income statement because it's for office. Carriage inward, yes, DM. Why carriage inward is direct material? Because the carriage inward for the direct material, we buy the direct material, so they need to bring in, right? So the carriage for that particular material. So direct material, carriage inward will be in a direct material. Okay, carriage outward will be income statement. So income statement we will just cancel it because we are not doing the income statement. Then continue. Inventory valued at raw material. Sorry, raw material is the direct material. Next one is work in progress. Work in progress is WIPC. Why I call this WIPC? Because 31st July, it's the end of the year. And finished good will go to the income statement. And loose tool we already calculated. Oh, another one. Can you see not? Wages. Wages of the factory operative is 3790. Accrued closing. If it is accrued closing, we plus or minus. You remember accrued closing, we need to plus. Okay. We have done everything. So now can you people do the answer using the discussion here? You pause this video, do the answer first. After you do the answer, you come back and check the answer. Okay, do first. Don't see the answer before you do. Do it yourself and then come back and check your answer. This is answer. You people can check the answer. Any problem, you can WhatsApp me and ask me now. Okay. This is the answer for A. Next one I will show you answer for. Okay, this is the answer for B. Thank you. That's it for this lesson. Any problem, anytime, you people can WhatsApp me lah. Thank you.